Welcome to 3 Points TV with Tom Lee. The yield curve, 10-year minus 3-month, inverted in late March, triggering a global panic and really increasing the resolve among our skeptical clients that the business cycle is now in late cycle and they're becoming quite defensive. We want to highlight why the yield curve inversion, while it's really important, only at a minimum stages the business cycle. It tells us we're not early cycle anymore. But it's a terrible equity tactical signal because the lead time is unknown and leaves a lot of money on the table. We think a more important signal was generated in late March. We've had a V-shaped rally since the beginning of the year, and it points to a 25% further gains based on analysis of the last 50 years. So here are our conclusions. 1, we're still bullish for the full year. We think, again, as we've mentioned many times in many of our prior reports, we think 2009 is the best analog for 2019. But we think this inversion looks most like 1998 because that, again, was a risk-off fall in the 10-year. Cyclicals typically lead following this type of yield curve inversion. In other words, it's not time to get defensive. Just as a basic overview, I want to highlight the type of inversion people are talking about. The 10-year has fallen below the 3-month yield. Now, that's a pretty unusual looking yield curve at the moment because parts of the curve are flat, parts of it are actually inverted, and a portion is actually positively sloped. This is actually, as we'll discuss later, a pretty unusual yield curve.
Just do it!
Now, there are many varieties of yield curve inversions that investors refer to, and the Fed. We've listed 9 of them here, but the one that roiled markets late in March was the 10-year minus 3-month. This has happened 36 unique times since 1954, while there have only been 7 recessions. So again, what's important to keep in mind is that this inversion, followed by a positive normalization, tends to happen frequently and gives you uncertainty on lead time to the next recession. The lead times are listed here, and as you can see in the last 3 recessions, this lead time was anywhere from 1.5 to 2.5 years, and in 1966 was 48 months. Think about that as a tactical signal. Do you want to leave that much money on the table if you might be waiting sometime until 2021 or even 2025 before the next recession? In many ways, an inversion of the 10-year minus 3-month lacks practicality because of the uncertain lead time and reminds us of the death touch, which was a martial arts maneuver referenced in the movie Men Who Stare at Goats. I've got a clip here.
But before he could leave, Larry arranged one last parting gift.
What are you... Oh! It was the dim mark, the death touch. It's forbidden in the New Earth Army.
What does the death touch do?
It kills you, Bob. One touch. That was it. You give him the death touch. Wong died.
Then and there?
No. About 18 years later. It's a thing about the dim mark. You never know when it's going to take effect.
Let me explain why we think this curve inversion is quite unusual. We've shown you on this chart below the earliest yield curve inversions in front of the last 7 recessions, as well as the current episode. In 6 of the cases, the yield curve inversion took place because the 3-month was rising. Now that's typically logical. It means that the Federal Reserve felt the economy was overheated and was raising short-term rates, which led to the 3-month surpassing the 10-year. However, in this inversion, and in 1998, the inversion was caused by the drop in the 10-year yields, which was driven by a risk-off maneuver. In 1998, it was the defaults and long-term capital, and in the current episode, it was driven by the weak German PMI data and European weakness. This is important from an equity perspective. In the cases where the Fed was tightening, the stock market eventually ran out of steam pretty quickly, as shown on this table. But as you can see in 1998, because it wasn't a policy-driven inversion of the curve, and the business cycle was only mid-cycle, the stock market managed to gain another 51% before peaking. Think about that for a moment. In 7 of 7 cases, investors left money on the table selling stocks at the first inversion. That inversion's a terrible tactical signal. I think the V-shaped move in stocks in the first quarter of this year is actually a lot more important a signal. Now, we define a V-shaped move as a 20% rise within 60 days. That's only happened 12 times since 1950, and those instances are listed here. The obvious question is, how much more upside is there to stocks 6 months and 9 months out? We've listed those here. And as you can see, there's only one instance out of 12 where equities didn't stage further gains 9 months later, which would be year-end 2019, and that's 1987. It might be helpful to visualize this as how much further can stocks rally into year-end. What would be the S&P year-end targets? The median and average point to the S&P exceeding 3,100 by year-end. And for the full year, implies that we're going to have a total gain of 25% in 2019, and reinforce the idea that 2019 looked a lot like 2009. As our clients know, at the start of this year, we said that 2019 looks a lot like 2009 and believe was pointing towards a 15 to 20% type total return year. Now we can add the V rally bottom as the sixth argument in favor of a 15 to 20% year or something that looks like 2009. Now let's turn to strategy. If we are late cycle and the curve inverts, we naturally don't want to be cyclical. And this table highlights the best relative return of sectors across those 7 periods when we saw the first inversion of the 10-year minus 3-month. But we think 1998 is the best analog. And in that year, relative outperformance was driven by cyclicals. We've listed 20 stocks here, which fall into those categories that outperformed in 1998, but are also ranked DQM1 by Sam Doctor's quant model. Thanks for listening. This is Tom Lee with 3 Points TV.